Welcome to our comprehensive XAUUSD market analysis for November 10th through 15th, 2025. This week witnessed a dramatic five-session rally that delivered 7% gains, pushing gold from $3,993 to a peak of $4,239 per ounce. The primary catalyst was the resolution of the historic 43-day U.S. government shutdown, which removed a major cloud of economic uncertainty. However, the rally occurred on weak volume, raising questions about sustainability. In this analysis, we'll examine the technical breakout patterns, fundamental drivers including Federal Reserve policy expectations, and provide detailed trading strategies for both short-term and long-term investors. We'll also explore divided market sentiment, with some analysts targeting $5,000 while others warn of correction risks. Let's dive into the data. Gold's November 10 through 15 rally was nothing short of spectacular. The precious metal surged 7% over 5 consecutive sessions, climbing from an opening price of $3,993 to a weekly peak of $4,239 on November 13th, before closing at $4,086 on November 14th. The primary catalyst was the resolution of the longest government shutdown in U.S. history, 43 days, which had created a data vacuum and economic uncertainty. This breakthrough reignited Federal Reserve rate cut expectations, with markets now pricing a 60% probability for December and 80% for January. However, technical analysts are raising red flags about weak volume during the breakout above $4,200, suggesting the rally may lack conviction. Market sentiment remains sharply divided, with bullish analysts citing the triangle breakout pattern targeting $4,250, while cautious voices warn that extreme net long positioning at 74% could trigger a near-term slide. Let's examine the weekly performance in detail. Gold opened the week at $3,993 per ounce, and reached a high of $4,239.52 on Wednesday, November 13th. The week closed at $4,086, representing a robust 7% gain over just 5 trading sessions, an average daily advance of 1.4%. Year-to-date, gold has now delivered exceptional returns ranging from 45 to 52%, making 2025 one of the metal's strongest years on record. However, gold remains 3.45% below its October all-time high of $4,381. This 5-session rally represents gold's most significant consecutive advance since mid-October 2025, and the 7% cumulative gain ranks among the strongest weekly performances of the year. The historical context is important. This rally occurred against a backdrop of improving U.S.-China relations and a strengthening dollar, conditions that would typically pressure gold prices lower. From a technical perspective, gold achieved a decisive breakout from a consolidation triangle pattern on November 7th, with the pattern now targeting $4,250. Key resistance levels to watch include $4,250, $4,240, $4,200, $4,125, and $4,100. On the support side, critical levels are $4,086, 100-day moving average, $4,062, $4,050, and the psychologically important $4,000 level. Below that, major support zones exist at $3,950, $3,929, $3,900, 50-day exponential moving average, $3,872, and $3,800. The triangle breakout is gathering pace and appears technically valid. However, there's a critical warning. Thursday's push above $4,200 occurred on weak volume. Historically, low-volume breakouts are prone to failure. Additionally, momentum indicators are approaching overbought territory after the 7% 5-session rally, suggesting consolidation or a pullback may be necessary before the next leg higher. 5 fundamental drivers powered gold's rally this week. First, the government shutdown resolution removed 43 days of economic uncertainty and data vacuum. Second, Federal Reserve rate cut expectations surged, with markets now pricing 60% probability for December and 80% for January, driven by weak jobs data and deteriorating consumer confidence. Third, unusual market correlations emerged, gold rising simultaneously with both the dollar and equities, a breakdown of traditional relationships driven by U.S.-specific factors. Fourth, safe haven demand remains robust as gold continues to prove itself as a reliable hedge against inflation and economic uncertainty. Fifth, structural demand from central banks continues, with average quarterly purchases of 566 tons and September ETF inflows reaching 150 tons. These 5 drivers create a supportive fundamental backdrop for gold, even as technical indicators suggest near-term caution may be warranted. Market sentiment is sharply divided. TradingView community analysts are bearish, pointing to a failed swing pattern with 2 consecutively lower highs at 4,375 and 4,243. They note all bullish trend structures have been violated, with downside targets toward 3,893. In contrast, Action Forex and Market Pulse are bullish, citing the decisive triangle breakout with a 4,250 target and Fed pivot expectations. However, they warn that 74% net long positioning could signal a near-term slide. Daily Forex takes a cautious stance, highlighting the weak volume on the push above $4,200 as a red flag for potential failed breakout. They note overbought indicators approaching exhaustion territory. Meanwhile, finance magnates reports institutional bullishness, with JP Morgan targeting $5,055 per ounce by Q4 2026, a 20% upside, and long-term targets reaching $6,000 by 2028, supported by central bank buying averaging 566 tons per quarter. For short-term traders looking at the next 1 to 2 weeks, we project a range of $3,900 to $4,200. The upside scenario involves acceptance above $4,100 to $4,125 on improving volume, which would open a path to $4,200 and the $4,250 target. The most likely scenario is choppy consolidation between $4,000 and $4,150 as markets digest the recent gains and await delayed economic data. The downside risk is failure to hold the $4,000 to $4,027 zone, which would trigger selling toward the 50-day exponential moving average at $3,900. For midterm positioning over 1 to 3 months, we project a wider range of $3,700 to $4,350. The bullish case involves a December rate cut with dovish guidance, propelling gold toward retesting the October all-time high at $4,381. The base case is consolidation between $3,900 and $4,200, with periodic corrections providing entry points. Several critical events will shape gold's trajectory in coming weeks. First, the release of delayed economic data, employment and inflation reports, will provide clarity on labor market strength and inflation trajectory after the 43-day data vacuum. Second, the December 17th through 18th FOMC meeting is crucial, with markets pricing 60% probability for a 25 basis point rate cut. The decision and accompanying statement will set the tone for Q1 2026 monetary policy. Third, Fed Chair Powell's forward guidance, dot plot, and press conference commentary on inflation outlook and the 2026 rate path will be critical. Dovish tone supports gold, while hawkish pivot triggers correction. Fourth, watch the January 30th, 2026 government funding deadline for potential shutdown risk. Fifth, monitor U.S.-China trade relations developments, as any deterioration would boost safe haven flows. Finally, track dollar strength and Treasury yield movements, particularly the 10-year yield at the 4% level. We present 4 trading strategies for different risk profiles. Strategy 1 is breakout continuation for aggressive bulls. Buy above $4,125 with volume confirmation. Stop loss below $4,000 for 3% risk, targeting $4,250 for 3% reward. Position size 2 to 3% of portfolio. Time frame 1 to 2 weeks. Strategy 2 is range trading for neutral traders. Buy zone 4,000 to 4,050 at support. Sell zone 4,150 to 4,200 at resistance. Stops below 3,950 or above 4,225, 2 to 3% per trade. Strategy 3 is correction buying for patient bulls. Wait for healthy pullback. Primary buy 3,900 to 3,950 at 50-day EMA. Secondary buy 3,800 to 3,850 at deeper support. Stop below 3,700, targeting 4,250 to 4,400 for 6 to 10% upside. Scale in 25, 35, 40%. Strategy 4 is long-term accumulation for conservatives. Dollar cost averaging approach. Buy any pullback to $4,000, 3,900, 3,800. No stop loss for long-term hold, targeting $4,500 to $5,000 over 6 to 12 months. In conclusion, 6 key takeaways emerge from this analysis. First, $4,000 is the critical near-term battleground. Holding above maintains bullish structure, while breaking below triggers technical selling toward $3,900. Second, near-term consolidation or modest pullback is likely after the 7% 5-session rally, with weak volume raising sustainability concerns. Third, bullish fundamentals remain intact, including Fed rate cut expectations at 60 to 80% probability, central bank buying at 566 tons per quarter, and persistent safe haven demand. Fourth, institutional targets are compelling, with JP Morgan forecasting $5,055 per ounce by Q4 2026, a 20% upside, and long-term targets reaching $6,000 by 2028. Fifth, risk management is essential given elevated volatility. Use strict stop losses, position sizing at 2 to 3%, and avoid over-leveraging. Finally, gold's secular bull market remains intact, and patient accumulation on dips targeting $4,500 to $5,000 over 6 to 12 months is recommended for disciplined investors.